If you ever went shopping in a big area, you might have seen this department store. For over 150 years, Saks has been the embodiment of American luxury and what it has to offer. At its peak, Saks isn't just a department store. It's a $10 billion luxury ecosystem with prime real estate, a core strong online platform, and a destination for people with high-end taste. Saks has been able to maintain dominance while keeping brand loyalty high. So why did a brand with one of the greatest status symbols file for bankruptcy? Well, here's how. Okay, so a couple things. One, my car battery just died because it's the dead of winter, so I can't do what I need to do yet, so I gotta call a person to come boost my car up. Two, I actually am in a good parking spot, so I didn't need to move today, but I wanted to make the video anyways. And so before I make the call, I just wanted to make the video on Saks. Now, Saks is a dinosaur company. Like, it's right up there with Disney and McDonald's. So why in the past 7 to 8 weeks I'm seeing in the news that they filed for bankruptcy? Hopefully we could get to the bottom of this by the end of the video. Instead of starting out with the origin story about Saks, I want to begin with what caused their decline. For that, we have to go back to the 90s. And at this point, Saks was past their prime, but it was still a luxury landmark. Just completing its 36-floor tower renovation, it increased selling capacity from 450 to 600,000 square feet, a near 30% gain that aimed to help modernize the brand. After the retail evolution seen the rise of discount stores eat department stores' lunch, the renovation in part was a way to solidify their luxury status, but while also creating what would be called a vertical destination that included amenities and zone department stores for certain demographics. But while the renovation was trying to draw customers in, the execs had planned to dump Saks out. From 73 to 1990, a company called Bat Industries was the parent company of Saks, a giant in the tobacco space. Essentially acquiring Saks and Gimbel, another high-end department store, gave them the cash flow and the diversity they were looking for to keep their company healthy. Gimbel couldn't match what their competitors were doing throughout the market, so they struggled in the 80s. But Saks, who was focused on bringing the best products to affluent people, thrived, expanding out to over 30 stores in high-volume locations. Due to what is called a hostile takeover, which is when a company is able to acquire another company without leadership interfering, Bat was pressured to sell off their assets, which were Gimbel and Saks. Enter an investment group called InvestCorp, and they had a track record of handling luxury brands. To fight off the recession during this time, InvestCorp put in a near $1 billion to make sure Saks made a good recovery. They continued to expand throughout the 90s, adding locations in states like California, Florida, and Texas. Store count went steady. By 98, they had 45 full-line stores. And with revenue reaching over $2 billion during this time, it enticed a holding company by the name of Profits. And at this point, Profits was known for acquiring department store chains. This spree of getting other department store chains made Profits' revenue go from $128 million in 93 to $3.6 billion by 98. That's crazy. With the capital and the leverage, Saks slid in as a good fit under them. Well, at least that's what the leadership thought. Net income plunged the following year because of merger charges. Not only that, but Profits' mid-tier chains took a blow. Expecting to see a 4% growth increase, a lot of stores had same-store sales only showing 1 to 2% growth. Their speedy acquisition led to excess inventory and slim margins as demand decreased in these locations. So although Saks was thriving, it couldn't steer the whole ship for Profits. By the early 2000s, Saks had reached an all-time high of $6.6 billion in revenue. It seemed like things were boosting until one of the most unfortunate events of the 21st century occurred. Consumer confidence declined a bit, as well as foot traffic. After this, sales took a sharp decline. Not only that, but this was around the time the dot-com bubble burst. At this point in time, any online company with .com at the end of it was a ticking time bomb to investors. People weren't too well focused on discretionary spending, but what they needed right then and there. While still focused on high-end viability by adding more Saks outlets, Profits divested certain chains to combat debt. But at the same time, they were accused in a scandal. They had to restate earnings from 1994 to 04 because they allegedly coerced suppliers into reimbursing excess inventory that was marked down already in a non-binding contract way, which was extremely illegal. Not only this, but they were also doing a bit of timing manipulation when it came to their operating leases. Saks eventually had to pay vendors back, cut employees that were involved, and accepted a permanent court order stating that they can't misreport or keep misleading records. And then the global financial crisis crisis came around, and Saks wasn't immune to it at all. Between '07 and 2010, revenue dropped 50% and same-store sales fell about 10 to 15%. To move inventory, they had to cut prices, and this wasn't easy because of their brutal cost structure. Not only that, but Saks also had store credit cards that it issued. Customers kept defaulting on card balances, which meant they were losing money on lending, not only retail. This era really exposed Saks for what it was. The crisis made it to where Saks really had to find a way to survive. They rebounded a bit in early 2010s by building up a bit of momentum, by enhancing stores and doing well on the digital side. This made Saks attractive to the oldest retailer in Canada, Hudson. The rationale for the merger was that it aimed to make North American luxury one. It included Saks and Lord & Taylor. So I'm guessing they were trying to do something that Bernard Arnault and LVMH are doing. Delisting it from the stock exchange under Hudson, it kept its luxury focus by gaining scale, capital, and real estate. Now, the same thing that happened to Saks under Profits was sort of what was happening here. Saks was carrying the ship once again. Lord & Taylor and stores based in malls were getting killed by having no foot traffic. Like many high-end acquisitions, HBC took on a lot of debt. Doing the smart thing, they closed stores, mostly Lord & Taylor's, as well as some weaker Saks locations. By 2017, it was clear they needed to focus on Saks, and so they did. Hudson went private, delisting itself from the Toronto Stock Exchange. And during COVID, store traffic collapsed 70%, with Hudson's overall revenue falling to about 25%. But Saks' digital business did surge, proving not everything needed to be relied on brick and mortars. Seeing this, Hudson leaned into fewer but more flagship stores, plus the digital side. They added 3 flagship stores and prioritized a merger through the mid-2010s. They closed the merger that had 4 out of the 5 top luxury department stores coming together to form what would be Saks Global. It seemed like it made sense, but did they get too ambitious? A lot of post-merger integration failures started happening. And even in Saks, supply chain system clashing caused SKUs to be duplicated. Missing vendor payments to prestigious brands like Chanel made customers go to rivals that had them in stock. Interest rates increased in 2025, causing Saks to violate loan agreements as they were unable to make payments. They had no other option but to file for bankruptcy. In fact, Saks already had creditor support and new financing lined up before bankruptcy to ensure everything goes smooth afterwards. Saks entered what was called DIP financing, or debtor in position. So what this means is, although they're filing for bankruptcy, the debtor, which is Saks, will still manage the business. Given $1.7 billion in emergency financing, they take $1 billion to pay employees, vendors, and cover rent and logistic costs, while they take the $500 to help relaunch the company in the near future. They aim to cut the debt by 50% and exit Chapter 11 by Q3 this year. Their prime leverage at this moment is their real estate. Now, what I do like about this restructuring is the fact that they brought in a new team. After former management almost severed ties with luxury brands, it made sense to bring in some seasoned people. I mean, it includes 2 people that had high positions in other luxury companies, a CEO who went through a successful restructuring with another luxury powerhouse, and an ex-Dior executive who will try to rebuild the trust with the luxury brands. I'm not sure how much pull they have, but we have to see how Q3 and 4 turns out. Now, obviously, Saks didn't have an option to not file for bankruptcy, but their credibility did save them. And although business is extremely volatile, what looks like a collapse in the news is simply a controlled rescue. Given how they managed the storm of the pandemic and the state of their business post-merger, they might have a shot. So I guess the question is, can they find a way of cutting debt without selling any core assets? Taking measures like monetizing their real estate and negotiating with creditors could play a big part. So it's not impossible, doable, but the execution is really high. Well, that's all for today's video. Comment down below and let me know your thoughts on what's going on with Saks.